structured approach provides no guarantee at all that it's going to last as long as you do. The RMD might, however, the RMD can be a dwindling amount so that towards the end, there's very, very little being paid out. There's another alternative, and that's investment annuities that you basically can also buy from an insurance company, and you pay an extra premium or cost, which provides a guaranteed lifetime income. Unfortunately, these also come with a bunch of restrictions, but they do work for some people. So this is pretty much the lay of the land for most individuals now when they have to decide how to spend down their retirement income. Next slide. So now we're going to talk about something that's different. And we're going to refer to it as a variable pension, but it goes under a whole bunch of different names. And the way a variable pension works is that it does pay out a lifetime income. However, that lifetime income is going to vary based upon the mortality of the people who are in a pool that they voluntarily decide to join, in addition to how the investments in that pool perform. This type of approach is available in the United States under certain programs. Certain church plans use them. We have some state plans that use them. The TIAA CREF, the CREF annuities have them, but they are not permitted currently for private sector employees under ERISA. They go by a whole bunch of different names. I've listed some of them, and there are others. People also sometimes refer to them as tontines, though they're really quite different than traditional tontines. But we're going to go with variable pensions, but again, there are other ways of referring to them. New slide. So how do they work? Well, individuals pool their funds together and receive payments that fluctuate based upon actual investment and mortality experience. They are used around the world quite often. And the next speaker, Steve, is going to talk about how they're now currently being introduced and used in Canada. And as I noted, they're not currently permitted under ERISA, but they are under other plans in the USA. Next slide. Okay. There are many flavors of variable pension programs. They can be structured in so many different ways. They could be voluntary or mandatory. They can be built using different types of investment allocation options. They could also be structured so that some of the variability is smoothed out as opposed to instantly being recognized, which could cause big jumps or decreases in the amount of the benefit changes. The basic concept is the pooling among individuals, but the actual details really are in the devil. The devil is in the details as to how they're structured. And there are many different structures currently being used all over the world. Next slide. Okay. So advantages to them: provide lifetime income. Because they don't have to hedge for unexpected mortality investment experiences, they can provide greater benefits than is usually offered by insured income annuities. Pooling of risks increases the benefits beyond the mortality risk beyond structured withdrawals. Employers can offer them without any risk, since all the risk is borne by the individuals in the pool, and many optional designs are available. So this is pretty much a brief overview. I think there may be one more slide. Maybe not. Nope, I'm done. But that gives you a sense of what we're talking about here. It just would be another approach to providing income. It's not there to substitute for income annuities or to substitute for structured payouts. Later, I may be able to discuss a little bit about how these different types of approaches kind of fill different needs, and how they can possibly be used together to really provide a good diversified approach to achieving retirement income. So I now hand it over to our friend from up north.
Thank you, Mark. And thank you for the invite today to allow me to speak to this group. As has been mentioned, I am a Canadian, and so I'm going to be making my comments based on the Canadian experience and certainly the experience of the Ideal Canadian Pension Plan. I'm here as the chair of the ICPP Management Board, and that's the board that sponsors, governs, and administers this trustee pension plan. It is a pension plan. But it's also a collective defined contribution pension plan. So it's defined contribution that provides payouts to pensioners directly from the fund. And I'm going to walk you through some of the things that have happened to get us to the point where we are today. So how did the Ideal Canadian Pension Plan evolve, and how did we create where we are today? Talk more about the concepts than anything else. So it's the Ideal Canadian Pension Plan, and we're here to provide reliable lifetime pensions for Canadian private sector employees. Can I get the next slide, please? And our mission is really very simple. For employers, we want to minimize the burden of the workplace pension plans, and it's multiple employers. We want to make sure that employers aren't suffering the burden of actually managing and administering pension plans. We provide those services. And for members, as Mark said, it's all about delivering that reliable lifetime pension that's simple and worry-free. That's what we're trying to do. So let's talk a little bit about what we've done to get there. So next slide. So we're a multiple employer. We designed the plan so that employers join the plan. We try to make it as simple as possible for each employer. We're trying to get to the point where the employer really views the ICPP in the same light as the CPP. They simply make contributions, provide the data, and then someone else, a third party, does all the rest. It is collective defined contribution, and we've established infrastructure within the plan to provide what are referred to as variable payment lifetime annuities in Canada. These are actual annuities that are allowed to be paid directly from a collective defined contribution pension fund. Next slide. We didn't get there in a day, and so I want to just walk you through how we got to where we are today, and really the evolution of the Ideal Canadian Pension Plan. Preliminaries, back 2002, I was working as an actuary, and I was helping pension plan sponsors really move from defined benefit to defined contribution. That was what was happening both in Canada, the US, and probably around the world. And we established for some of our clients at that point in time a no-choice defined contribution component in a single employer pension plan. What we're really trying to say is we designed a defined contribution pension plan, it stayed in the existing plan, and the members didn't receive choice with respect to the investments. One fund established for them. So we started down the path of having a collective shared solution. And that was in 2002. So we've had over 20 years of experience with this style of plan. A little later on, 2007, some of the plans eliminated the defined benefit portion, especially for the active members. So we ended up with a no choice investment single employer collective defined contribution pension plan. So we took another step towards where we are today. Then after 2007, we decided we needed to do some research about really what the ideal solution should be. We weren't referring to these plans as anything except collective defined contribution. So we looked into what would be an ideal Canadian pension plan. And a number of things happened. First of all, because of our research, we decided to replace a concept, the hurdle rate, which is a concept that's used in many pension plans to manage the increases or the adjustments to pensions on a year-to-year basis. You establish a hurdle rate, often a conservative hurdle rate, a real rate of return of about 4%. And then if you obtain better investment returns than that 4%, you increase the pensions and pay by the difference. So you earn 7%, you provide everyone with a 3% increase. We altered that. We added a hurdle mortality assumption to the hurdle rate to create a hurdle annuity. And that hurdle annuity concept allows us to do all the administration and deal with fairness within the ideal Canadian pension plan. At about the same time, through our research, we decided that we needed to really separate the accumulation phase and the payout phase within the plan. And we really started to think and conceptualize the plan as two separate plans, accumulation phase and a payout phase. And we created different solutions and strategies during the accumulation phase and the payout phase. We then looked at the whole issue of providing the year-by-year increases during the payout phase and decided that a 5-year recognition of the payout fund's annual experience would be appropriate. Why 5 years? Our analysis showed that it provided a stable enough environment. And because of the way we designed it, it really provided a bit of a surplus, a little bit of a hedge in most years that protected the downside risk associated. We then decided that we needed to concern ourselves about making the plan multi-employer. So we did research along with lawyers because we were worried, how could we do this within the regulatory environment? Turns out we could do it within the regulatory environment. We just needed to get good legal advice. And so we established a multiple employer solution. We then looked at solutions within the investment side. How should we invest the money? How should we transition from accumulation to payout? And we did a bunch of that work. And by 2012, we had really designed what we thought was an ideal Canadian pension plan. So starting in 2015, implement. We wanted to invest the monies in a certain way based on our research, and we tried to find external managers, but we were a startup. Nobody really wanted to do it. So we established an investment management firm in 2015 to at least get us started with the ICP investment funds. We then established a single employer ideal Canadian pension plan. We had a single employer willing to do this. And then we added a number of other employers, but in a single employer environment. And then in 2021, we were at the stage, 5 employers, we were able to get 2 to sponsor the multiple employer plan, and we established a multiple employer. So a lot went on, and it's a lot of work. It's 20 years. So, you know, it's really, but I think the one thing that I can say to you is take it and view it as a process. To get to where we need to be, you have to start. You have to take the first step. Eventually, you'll get to your goal. Can I have the next slide, please? We also have other things that we want to do. One of the biggest problems we have in Canada is we have self-employed and contract employees who are really orphans within the pension system. They really only have access to what I think you would refer to as IRAs. In the US, they're called Registered Retirement Savings Plans, RRSPs. And we're trying to allow them access. And again, we're doing the research and working with lawyers to try and provide for access to them. And it may, I think it will, turn out to be, we already have the regulatory environment to allow us to do that. We've done a lot of work in answering the question, how safe is our pension within this environment? And we need some more work on benefits at risk. How do we give people enough information about their current pensions and how safe that current pension is to allow them to basically budget over the near term. We're also looking at other possibilities in terms of the variable payment life annuities. We have one solution. Should we have two within the plan? Should we have multiple solutions? Those kinds of things. So those are for future development within the ICP. Next slide, please. So give you just a bit of an overview. The ICPP is one plan, but we actually have 4 forms of benefit payout strategies within that one plan. If you look at the far left, the ideal benefit, it's the benefit for everyone. And this is where our variable payment life annuity comes in. It provides basic lifetime benefits with inflation protection, full shared risks under a VPLA. And everyone in our plan participates here. And for the low income individuals, that's all they participate in. If you move to the next, the ideal benefit plus is really intended to provide lifetime lifestyle benefits. And virtually all of our middle income employees would be in this plan. But we use for this payout what we refer to as life income funds, which is very much like the individual strategies that Mark talked to you about. But they're paid and managed from within the fund. So we have shared resources, we pay individuals, so no mortality sharing for this part of the benefit. We also allow our members, if they so decide, to buy insured annuities within the plan. So we do that work for them. But if they want to do that, we start investing the funds and transition to the purchase of that insured annuity over a 10-year period. That all happens for them. This is really used by the more senior, higher income individuals. Most of our members do not use this payout strategy at all. And then finally, if that wasn't enough, we also have a discretionary benefit that is self-directed. This is for generally senior executives, are the only ones that use this. And they have additional monies in place to provide for a more variable income at their discretion. Next slide, please. Within our plan, what's really, really important, and we think what will lead to our success, is our risk mitigation and control. And some of the most important things and things we've learned is, it really is important to help members with transfers between our investment funds, which really means transitioning from the accumulation phase, your active working lifetime, into the payout phase, whichever one of those 4 payout phases we're talking about, in a reasonable way and in an automatic way. We have developed algorithms that does this and reduces the risk associated. We think the 5-year granting of raw pension adjustments. So we do evaluation every year. It's an actuarial evaluation every year, and we determine how much we can justify in terms of a raw increase. We then spread that increase or schedule that increase over 5 years. That tends to, because the assumptions we use are on the investment side are conservative, the hurdle rate's 4%, that tends to create a bit of a hedge. So in bad years, like last year, we have enough so that we don't actually have to decrease the pensions and pay. And we didn't have to decrease the pensions and pay last year. We also have the very purpose-specific investment strategies, and these purpose-specific investment strategies reduce the risk of them for the members. It reduces, because we're long-term investors, we can avoid unnecessary expense, and we can avoid zero-sum asset classes. We're able to invest in a very responsible way and in a way that we can communicate to the members. What's really important is, because this is a full plan, we have an ongoing conversation, a different conversation perhaps between the active members and the pensioners, but an ongoing conversation that's specifically designed for them, that allows them not to worry about what's happening within them. And I believe that's it for me. Thank you for your attention, and I'll turn it over to Michelle.
Thank you, Steve. That was such an interesting presentation to see the live effects of one of these solutions. I have been for probably 10 years now, researching premises around what David John will call a tontine, what in Canada they call a variable payout pension life annuity, and what I will call pooled longevity solutions. Because this is not yet a popular thing, we all have a different term for it. But the upshot is a non-guaranteed way for participants to share longevity risk and get a higher income from it than they could get from either insured approaches or taking withdrawals on their own from an investment account. Next slide, please. So it's no secret, my title on this slide, Americans, and that's Canadians as well as citizens of the United States, all Americans need lifetime income support. The income solutions that we all are going to need are more likely to be delivered by employer-sponsored delivery mechanisms now than they were in the past. In the next slide, I'm going to talk about trends in terms of choices that employers make on the kinds of plans that they offer. But to Steve's point about the Canadian space, we in the United States have also have a large segment of our population that doesn't experience employer-sponsored plans. So those people are typically woefully undercovered from a retirement savings perspective. And so everything that we can do to help make their spending more efficient is a useful thing for people who are in our seats to do. So some of the reasons why we need more lifetime income support than previous generations might have. My generation is living longer than my grandfather's generation did. And so the longer we live, the more likely those years are not productive years from a working standpoint. They might well be thought of as productive towards our family legacy, but it's unlikely that we are able to add to the workforce for as much longer as we are living now. Increasingly in the United States, at least, we see plan sponsors more likely to prefer to keep their participants' assets inside of their plans after retirement. It used to be the case in the United States, and still is fairly prevalent, that at the time of retirement, the average participant in a plan who has a couple $100,000 or more is likely to communicate with a financial professional. And when they do, it's very likely that that financial professional is going to take those assets out of the highly protected employer sponsored plan and move them into a more expensive retail product. So having more and better solutions available in the in-plan space helps Americans to get access to efficient lifetime solutions. Having lifetime income solutions available helps the employees of an employer to retire when they're ready, not when they hit their magic number as to when they can afford retirement and may have to live or may have to work longer than they planned and longer than they may be efficient for because they need a higher income rate from their assets. So again, these more efficient solutions create the opportunity for better life for the people entering retirement. And then lastly, there are some regulatory changes recently that really impact what types of solutions can be possible inside of employer plans and how heavily the government regulates what I previously mentioned, that typical movement of assets out of the protected plan environment and into the retail environment where products and services are more expensive to deliver. So the Secure Act is something that passed in 2019, enabling more plans to feel comfortable introducing income solutions into their plan. And the Department of Labor has communicated a lot about its concerns around fees and how it will intend to crack down on advisors seeking to exploit that difference of in fees between the individual retirement account space and the 401k space. Lastly, last factor that I think is important to how the landscape is changing so that we should consider these more efficient income solutions is that last year, it was required no later than with second quarter statements that every defined contribution statement have on it a retirement income projection based on the account balance that was on the statement that the consumer is accustomed to seeing. So this is the second year in which upon conclusion of second quarter, participants will see a translation of their assets into income. And if next year is anything like how last year was, I will get a lot of calls about how do I get this income number that's on the bottom of my statement? Where on earth would I find it? It's not in my plan. And that really does just drive individuals into the hands of a retail financial advisor. So I personally have a strong preference for greater availability of solutions inside of employer protected plans. Next slide. And this is a really enormous trend that is the slide that scares me awake at night. This trend comes from data compiled through the Center for Retirement Research at Boston College, and it communicates the share of households that used to have a defined benefit pension plan based on their year of birth as compares to now. So I look at this graphic and I think about my father, who was born in 1945. So I and my mother was born in 1952. So I look at 1945 and I see, okay, more than half of the time these households had a defined benefit pension. I go down to when my mother was born, 1952, and if the household had been headed by her, in her cohort, about under 25% of households had a defined benefit pension. Now, in my particular instance, my mother was the one who had the defined benefit pension off of which my father lives. He deposits his retired minimum distributions into a brokerage account when he has to take them. He doesn't need more income than he gets from my mother's defined benefit pension. And he lives in a neighborhood filled with lots of people who have the same characteristics he does. Now, I think about my birth year, which is not on this chart, and I know that the trend is such that my birth year, it comes close to 0% of households when it comes to the private sector. In the public sector, there still are a number of members of my age cohort who do have access to a defined benefit pension, but that most people do not work in the government. Maybe that's 10% of the population, and 90% of the population does not have a defined benefit pension. They are supposed to find access either to a defined contribution plan that they can save in or an IRA that they can save in. And then they're supposed to figure out how much they can spend in retirement. And they're supposed to do that without receiving guidance from an expert. Somehow that is expected to occur. I am less certain of what a good strategy this is, because when institutions manage defined benefit pension plans and they had to keep those portfolios funded to cover the benefits that were promised to those employees, those accounts were, as I said, professionally managed, and they were managed from the perspective of needing the assets to cover the liabilities, which were the income streams they needed to provide. Well, how on earth is the average American supposed to know how much of a liability they have already incurred merely by living and desiring to have retirement income that supports them in retirement? People do not project their own liabilities. They don't know how much retirement income they are expecting or needing. We are at this moment guiding them to just save as much as you can. If you haven't saved enough, you're a bad person. If you have saved enough, that makes you a good person. And we judge that as a society. And this is not, in my view, the most effective and efficient way to help people through retirement. Next slide, please. So these are all factors that, for those of us who are looking to educate advisors or are trying to help individual consumers, these are all factors that need to be taken into account when you think about retirement income. A person needs computer-based tools that enable them to project out what income they will need, what assets they have. They need to make decisions about which products or services they're going to select that will enable them to generate the income that they see from the tool they've accessed that they will need. They need to make a personal decision about whether or not they want to guarantee the income that they're going to receive. They need to make decisions for Americans about when to take Social Security. Should they take early? Should they delay? Is there longevity in their family? These are all factors that a person who's optimizing their retirement income would need to know. They need to think about taxes. How do you draw down account balances in a tax efficient way? How do you spend in an efficient way? Are you more inclined towards spending more early in your retirement when you may be more active? Then they sometimes call those your go-go years. Or do you want to have more of your assets available in what some may call your no-go years towards the end of your retirement, when you might need more for example, for long-term care kind of expenses? And then lastly, how to go about generating a retirement paycheck. These are all factors that Americans need to consider as they implement strategies for retirement. And without access to a professional, figuring this out is incredibly hard. Next slide, please. So why do I think that pooled longevity solutions, or Tantians, or pick your name for these solutions, but why do I think they're important at this juncture where we stand now? I think that they're important because they generate more income, a higher average income level, than does either a safe withdrawal approach or an insured annuity, because there isn't a guarantee as to the level of income that the person is going to experience in the future, only that they will receive it and it will be fair. That can be funded in a much more efficient way than can either the uninsured or the insured, fully insured approach. Because they know they will get income for the rest of their lives, no matter what happens within a range within their account. That makes more people feel more comfortable staying invested in the market for longer than they would have. On average, not in any specific year, but over time, if you can afford to be in the market, over time, the market will generate higher returns than a fixed strategy. But if you're in retirement and you're spending now, that can really be a challenge to your overall approach to investing and spending when something bad happens in the market. If you have guarantees, and if you have pooled longevity solutions involved in your full retirement accounting, you might feel more comfortable being somewhat more aggressive with some of your assets, which would enable you to experience more market participation over time, which on average will give you more income over time. My view is that these, I say Tantians here, that this pooled longevity approach is the lowest cost method to deliver lifetime income of which I am aware. With that said, there are lots of constituencies in the United States that don't per se have a preference for this type of solution, since it's an efficient solution, so it does not have the fee levels that other solutions do, and that can cause manufacturers of products to prefer to manufacture different products. For the types of financial professionals that get paid on managing assets, those are people who don't prefer income solutions, because any income drawn from the account reduces their compensation. You know, there are lots of constituencies to consider here, but again, we're here doing this presentation because those of us who are here believe that these solutions are oftentimes more efficient than what's currently, in the United States at least, available on the market. So with that, I'm handing it over to a repeat presenter for this audience, David John.
Thank you very much, Michelle. I find myself at the end of the panel following three excellent speakers. And I'm reminded that former Vice President Hubert Humphrey, when he was in this situation, would start his presentations by saying, everything has been said, but not everyone has said it. So I'm going to try to add on a little bit of value here, and then we can go to the discussions. I'm going to look at two different types of these pooled retirement plans. The first one, obviously, being the tontine. Now, the tontine has a really neat name, which goes back to its history in medieval times, actually. It's named after Lorenzo Tantia, who did not develop the tool, but is known for popularizing it. A tontine is an investment pool where participants receive both the investment income and a share of the assets from deceased members. I'm going to call those mortality credits. But basically, this is the money from people who died before you did, if you're a participant. It can be a closed pool, which typically would be, for instance, everyone who's retired in 2023 was born in such and such a year. Or it could be an open pool where you continue to have more and more people join the pool, regardless of their age. You can manage it either way. Couples can join, and they're usually treated as one individual, so survivors' benefits are also possible. Now, the bad news, if for some people at least, is that once you join a tontine, you're in it. You cannot leave there. And the other thing is that there are no assets left over at death. So whatever you put in the tontine is definitely not going to go to your heirs. Back in the early 1900s, tontines were the usual way that people received retirement income. However, the insurance companies, which sold those at the times, to be blunt, cooked the books so that most people who depended on those were actually cheated. They either got nothing or they got much less than they deserved. So the state of New York banned them in the early 1900s, and they are technically illegal at this point. That's probably going to change fairly soon. Now, just to repeat here, the value of an investment pool is that you're not managing your own money. So you've got professionals dealing with it in a much larger pool of assets than you possibly could. And that means that they can invest in things that you wouldn't be able to, certain types of real estate, certain types of, if you're in Canada, infrastructure investments, but a wide variety of things. And they have much more ability to produce the kind of returns you need at a lower cost. So let's move to the next slide here. The advantages are fairly simple. You have mortality credits. Now, again, what happens with the mortality credit is that the people who die before you do, if you're in the pool, their money starts to be divided out for you. So in the short run, you're going to be receiving the investment returns on both your money and a share of the investment returns from the people who died before you did. This gives you a greater return on your money. So frankly, you can't run out of money. That's the way the pool is organized. They also serve as a hedge against investment losses or inflation, so you're pretty much protected there. And in this case, there's no contractual guarantee. So in other words, you're not guaranteed a certain level of income. So you don't have, for instance, the kind of regulation that an insurance company has, and that gives you much lower costs. Now, there are also some negatives. Inevitably, there are negatives for everything in life. The first negative is that because your benefits increase, assuming you live longer than they do, you're going to get your highest level of benefits at a very old age. So this means basically when you're 95 or 98, you're going to receive the highest monthly amount that you possibly could in this tontine. The problem is that there is a new Rand Corporation study which confirms what we've all known for years, that retirement spending declines between 1% and 2% a year, regardless of what your income is or what your financial status is or your gender or your race or anything like that line. So basically, in a traditional tontine, you're receiving the greatest amount of money at the point when you really need it the least. And of course, as I say, there is a very questionable legality at this point. There are also a number of groups who are working to change that. Let's move to the next slide. There is a variation on a tontine, though, called a level payout tontine. And this was developed by Moshe Milevsky, a fantastic Canadian researcher, and the late John Foreman, who used to be with the law school at the University of Oklahoma, brilliant man. And what they've done is to develop a kind of a tontine that pays a stable amount for life instead of one that gradually grows. And the amount that you're going to receive if you're in this kind of a tontine is higher than the amount that you would receive initially in a traditional tontine. In order to finance that stable payment, it means that they're going to consume both some of your investment and the growth that comes from when people die before you do. This means essentially that rather than your investment being untouched, it will be touched slightly. The equation to do that is somewhat complex, as I say, but it's still fairly low risk. And this is true, as has been mentioned earlier, the larger the pool that you have for any of these types of programs, the more successful it's going to be. So the encouragement and experiments that are going on in other countries at the moment with tontines are trying to encourage people to come from many different employers and many different types of individuals with different types of careers, so that you can basically predict in mass, if not individually, what the longevity is going to be. Now let's look at how these actually operate here. This is, sadly, this is your first level of a charts here. Let's go, there we are. So the pink one here is looking at the operation of a total tontine. It is essentially, you will see the darker level, those are the investment returns that are coming off of the base amount that's in the tontine itself. And you can see those are steady. But as people die, the number of people that pool is divided among gets smaller and smaller. And as a result, the payouts get higher and higher. And as you can see, the longer you go, the higher the payouts get. Now, looking at the middle slide, the blue one here, you see how the stable payment tontine operates. In this case, you see the darker blue is slowly going down because that's being consumed first, and then the mortality credits build on top of that. But regardless, you have a stable amount that's going on. Now, for an individual, there's a question, because this is not guaranteed. How does this operate? And that's what the slide on the far right is. In this case, it's similar to what you saw for the level payout tontine, except you see that little tube at the top here. This is from a Brookings paper, and we ran 1,000 simulations of how these would turn out. So the amount of income is the average there, the median is the solid line in the middle of that little sort of medium blue thing at the top. And the higher point on the dotted line is the most you would receive in those 1,000 simulations. And the dotted line at the bottom is the amount that you would receive in worst case. So as you can see, you would still come up with pretty much a level amount of retirement income that you could depend on. So now let's move to the next slide, and we're going to look at a different type of one of these pools. This is a managed payout fund. They're legal, they're available right now. Most providers offer them. You have an investment pool, which is invested very similar to that of a tontine or the other types that you've been hearing about today. In other words, professionally invested, the larger the pool, the better, et cetera. And in this case, you are not guaranteed a benefit amount, and your benefits vary according to the performance of the pool in the previous year. So every anniversary date, whether that's January 1st or some other date, they will send you a notification saying, for the next 12 months, you are going to receive a monthly payout of so much, and that's guaranteed for the next 12 months. And then that'll be revised going forward, depending on how the pool operates in the next year. One advantage of this is that this is flexible. So you can withdraw from the pool at any time and take your remaining money. So in the event that you have some sort of a financial problem or your circumstances change or something along that line, you can withdraw from this and find a better solution at any point. At death, unlike the tontine, any money that you've got remaining goes into your estate. So it would go into your heirs, and that satisfies the needs of a proportion of individual. And as I say, this is legal. It's available right now. It's an investment opportunity that provides lifetime retirement income. It's not guaranteed. We don't guarantee that necessarily that you're going to receive money for the rest of your life, but the odds are very, very high, very definitely structured in your favor. Now, the question then comes, if, as Michelle pointed out, most people don't have guidance as to what decision they're going to make. And we solved this in the saving part of this by putting in automatic mechanisms that help people choose how much to save, what to save in, and things along that line. What would be an automatic payout mechanism? So let's look at the last slide here before we go to the discussion. So which is the automatic choice? People need guidance of how to convert their retirement savings into income. Most firms do not provide that. And frankly, a financial advisor is usually an option only if you have a lot of money. Together with Social Security, you need a stable income that at least covers your basic expenses, housing, food, transportation, some medical care. Circumstances in health care change suddenly, and flexibility is important. So this is a Brookings paper. We have suggested that as an automatic choice, the phased withdrawal plan that you just saw in the previous slide should be considered as an automatic option for people, because it helps them to understand, as you heard much earlier, that this is your income. And rather than having a significant number of people who are either going to spend it too fast or they're going to hold on to it in fear that there's going to be some sort of a crisis where they need everything, this gets them so that they're actually receiving income, and it's flexible enough so that if they decide they need an annuity or some other variation in that, they can move some or all of their money until that. So with that, I'm going to stop. We're now going to go into a discussion and hopefully get some reaction from people who have been listening to all this. Thanks.
Thank you, David, and thank you all for this really 360, I think, view of our topic today. It was very thorough, very comprehensive, and I just like how all of the presentations really support each other. The issue, obviously, and the decisions that people have to make are very complex. And so I would like to start us off with a very simple question, sort of going back to the issues that Michelle raised, and then David came back to this with the automatic option. How are people getting information about what they need to do? What are options available to them? It's great to add more opportunities. We have some great opportunities for people, some great strategies. We have other opportunities to consider, but just taking us a step back and looking at the task that we have in front of people.
I'll start very quickly. One of the problems that we face is that many of these options are discussed in terms that most people don't understand. And all too often, people are getting advice from their well-meaning brother-in-law who really doesn't understand what he's talking about, or from something on the internet where somebody is promising you a huge return, which you'll never see, but he's going to get rich because you clicked on that. So all too often, people actually aren't getting the kind of advice they need.
I'll second that. Mark, please.
No, I would just, I agree. People get information from a lot of sources, and often they're really not suitable for their particular need, because somebody's coworker decided to buy an annuity doesn't mean that you should or should not. So that's an issue. I think many of us here in a perfect world would like to see employers do more to step it up, provide more options under retirement plans, DC plans that pay income, possibly with a type of default option that David, expressed. But if employers are not prepared to do it, or individuals are not covered by employer plans, it creates a huge vacuum. And how that vacuum can be filled is difficult to answer, but I do think back to what Steve said about, in Canada, they have these multi-employer plans where, individuals from many different employers kind of jump in, and you don't leave the liability on the employer or the work on the employer, but they go into these standalone systems. It is conceivable that, and it's not happening today, and there may be some legal reasons why, but the concept of some sort of an exchange, some non-employer-based program where individuals could roll their money from retirement accounts and IRAs into a program that provides only one service. And that one service is to take that money at retirement and provide income to the participants along with education. So, they collect the money, provide education, provide modeling tools, and then go ahead and pay out the money. This takes it out of the employer's hand, and it works for people who have IRAs all over the place, and for people who may not be employed by our plan. Let's hope that we don't have to go there at some point. I would prefer to see employers take on this responsibility. I think some of the state-initiated plans are looking at offering directly income options, but it is a challenge. And as I said, there's pieces to the challenge. As a basic education, there's modeling tools, and then you need to be able to implement the solutions.
Yeah, I'd like to add a few things. With respect to what we are trying to do with the plan that we sponsor, we think that one of the most important things that we do is the communication packages that we have put together and the education packages for members while they're active and members during retirement. And it's early days, but already we found that members do understand what the issues are and what's important for them. But we make sure that we're talking to them about their income replacement, their basic needs, a lot of the stuff that David talked about in terms of what you're trying to accomplish and how you're trying to accomplish it. It becomes the ongoing conversation with the members, and that prepares them for the transition into retirement. And then the ongoing conversation with them during retirement also allows them to have some success in the retirement. My biggest concern about people in retirement isn't when they retire, it's how do you expect an 85-year-old or a 95-year-old to look after their financial needs, right? That's a point in life where they can't. And if we don't have solutions that help them, we're beat, right? And the tsunami of the boomer generation and beyond is going to hit us, and it's being exacerbated. Issues are really going to come to the fore because the defined benefit pension plan, so the managed payout system, has disappeared. We need to replace that.
I want to agree wholeheartedly with Steve on this one. I feel that with the loss of the defined benefit space that we've sort of presupposed that defined contribution system, which only covers a fraction of Americans anyway, but we've decided that it's just as good, when in reality it leaves the exposure, as Steve pointed out, on people who may not have all of their faculties at a time when they really need to be optimizing. So, you started this round of questions, Rena, asking, where are people getting their information now? To which I think the only correct answer is television. But and I don't think that's correct, because I don't think that's where they should be getting it. For example, there is one entity that tends to put on commercials that say, "Because I hate annuities, so should you." Well, unfortunately, the reason why that entity hates annuities is because it's incompatible with its compensation model. So that's not the reason why you should hate annuities, if you do hate annuities. I personally love them, but everybody's entitled to have their own opinion. Everybody should get personalized guidance. So to the extent that a person does not prefer to use a financial professional or does not have access to one, then going to dispassionate expert sources is a good thing to consider. And so I'd like to directly steal David's thunder by saying that the AARP site might be a good place to consider looking for information.
Thank you for that.
I'm going to support CARP instead of AARP.
Thank you,
CARP.
Michelle. Yeah,
Okay.
we are actually working on, I think there are some great sources out there. I think that's a great point, to the credit of AARP, obviously, and a lot of other, even our state website has a lot of great information here in Iowa. But to that point, we are actually working on compiling some information to have available on our website. But that's a need for sure. Even though the information is available, getting to it is another step. I think we have really a nice variety of audience questions, and if you don't mind, I would like to dive into those because we have some really good questions. One is actually at the intersection of two of our policy areas, so both retirement security and disability policy. And so the question is, are tontines open to participants who retire early due to disability? And basically, what is there anything else that needs to be considered in this situation?
It depends on the tontine. And the usual answer would be yes. I mean, if the tontine is not structured so it only includes people who were born in, say, 1962 or something along that line, yes, I mean, the open-ended tontines would accept people who are retiring early because of disability. The one thing to consider at that point, however, is what that might imply for longevity, because again, the way you win with a tontine is by living a long time.
Actually, can I take you up on this, David?
Sure.
So that was one of my pre-prepared questions, right? So can we talk about the longevity differences a little bit and the inequality there, and just the implications of, you said this, we need to have a variety of choices, but if you just want to say a couple more things on this.
Yeah, this is really an important point, because if you talk to people en masse, the larger the group that you have, you can pretty much predict what longevity is going to be. But the fact is, depending on the composition of your population, women in general live longer than men do. Same income, same health situations and things like that. Various racial and ethnic groups live longer or shorter. So typically, again, just using generalities, an Asian American is going to have a higher longevity than, say, a white American is, while a Black or Hispanic one will have somewhat lower, Black lower than Hispanic. And again, that's a generality there. So it depends on how your pool is put together and how this is structured. It is important for the individual to think about that before they go into something like a tontine that's irrevocable. For them, it may well be that something like a phased withdrawal plan, because all their assets are not locked up in perpetuity, might be a better choice. But again, that's up to the individual.
Yeah, I mean,
I'd like to add, oh, sorry, Mark, go ahead.
Well, I mean, I agree with everything David just said. Remember about that, this quote unquote inequity already exists with Social Security, and it already exists with traditional pensions. Those who have the longest life expectancies or live the longest will basically get the greater benefits out of those. But yeah, individuals have to make choices based upon their particular circumstances and how long they think they're going to live. And they need the education. It's very interesting. There was just a study that was done by Deloitte, and most people age 65 believe that they're not going to live past age 85. Well, it turns out that at age 65, life expectancy for a male is 87 and for a female is 89. So that people don't even know what their life expectancy is. That's got to be part of the education process. And, there are very high percentages that people could live to 90 or 95. So this is an argument only for people understanding their choices, and understanding what options are available. I, for one, am big, and I think a lot of us are, in the concept of diversification. We diversify our assets. We diversify a lot of things in our life. If we have different ways of drawing down retirement income, a managed approach, as David discussed, or a lifetime income annuity, as Michelle likes, or someday, hopefully, a variable pension. Concept of using all of them could make sense. When you do the math, when you do the analysis, a lot of times diversification is a way to go where you can maximize results and minimize volatility. But we are just, in this country, not at the place where we need to be in terms of delivery of this type of education.
Yeah, I want to just add to these comments. In the ICPP, what we do with our variable payment life annuity, so our version of, David would probably call it a tontine, I'm not sure we would, but our version of the lifetime income, we limit the amount that any one individual can purchase. So basically, they can only cover their basic needs. And by doing that, we think we reduce the whole notion that, gee, I might end up being a big loser. Like no one who's in really good health can sort of game the system by overbuying, so to speak. That's why we have the variable payment life annuity with the life income fund, which is a personal income that can be adjusted to meet personal needs, right? We try and deal with that moral hazard and that advantage associated with a difference in mortality. So it's one mortality basis for everyone. We take into account age and all of that when they buy in. We allow disability, but we certainly make sure that we explain to people that they are disabled, what that can mean to their longevity, and maybe a life income fund is a better option for them rather than DPLA. But you know, it is an issue, and it's an issue best dealt with by having honest conversations with the members, and not just at the end, but have them understand why in our case, the VPLA just covers basic benefits. It's to avoid some of these issues that we talked about.
Great. Yeah, thank you for making that clarification, Steve. I have I believe probably an easier question, but that really deals with your own experience at the ICPP. That was one of our first questions that came. And it's asking you to explain how you were able to avoid reducing benefits during the negative returns in 2022. Is that too much in the weeds?
Well, I can answer it really succinctly. The returns in the 4 years prior to 2022 were sufficient because we didn't just provide a full increase each time we had these really good returns. Those high returns offset the low returns, the terrible returns that occurred we actually go September over September. So September 2022, they were sufficient to allow us not to have to reduce the pensions. And basically, the design leverages on the reversion to the mean aspect of most of the market, of the equity markets in particular. And you know, the 5-year averaging helps. Our analysis showed that even in 2008, 2009, when you would have expected a huge drop by using our techniques, the decrease only occurred once, and it was less than 1%. Our analysis on benefits at risk indicates that 19 and 20 times, 95% confidence that there will be no decreases at all in the pensions and pay. Right? So it's a question that we continually try to answer, and we do a lot of work on the whole issue of benefits at risk. But we design the plan so that it's less likely to have a decrease, right? If you have a tontine that just reflects the actual experience each and every year in totality, then last year you would have had a decrease, right? You would have had increases for previous years, bigger than ours, but a decrease last year. We just had smaller increases followed by another increase.
I just point out that the tontine, it would depend on how many people died in the previous year also. So
that is true. And for us, we're small enough at this point that no one died, but they're young enough that the mortality loss, so to speak, was sufficiently small that it did not require a negative adjustment.
Great. Thank you, Steve. David, back to the automatic choice. There is a question that is trying to clarify if you view this as a temporary solution until a permanent solution is found, or another policy proposal.
You know, when it comes right down to it, it is something that could very easily be a permanent choice, because for probably the vast majority of people, it's going to provide a decent level of retirement income. We know that when people are confronted with a choice, if they don't understand the options, if they don't have an obvious other way of moving, they're not going to make a decision. They're just basically going to sit there. This is one of the weaknesses in just educating people. That's why we have automatic enrollment and automatic escalation and the like. So for probably the vast majority of people, they could be in the phased withdrawal plan for the rest of their life. For others, for instance, if they discovered that they needed or wanted to guarantee income, they could pull money out of that and put it into an annuity of some kind or another that guarantees that they are covered up to that level. But the key is to help people get over that hump of having the biggest amount of savings they've ever had in their life. And now they're told, now it's up to you to figure out how to do this. And here are all these questions that you don't know the answer to that you need to answer to make a good decision.
Yeah, exactly. I think I really benefited from reading up on that Brookings paper. So I will take the advantage again to promote this where you're discussing. It is not a very easy necessarily answer in how you set this up, but there, again, like everything else, some advantages to this. The last question, it depends, possibly the last question is circling back to, there's actually a couple of different questions on this, sort of the difference between the academic and policy support for either Tontines lifetime income solutions versus the regulatory environment right now in the US. And one of the questions specifically is asking, what are ERISA specific concerns that are barriers to this, and why overall there is lack of support for this as a policy alternative?
I don't know if there's lack of support. The problem is that ERISA, as it is written, it allows for benefit payouts in both defined benefit and defined contribution plans to vary based upon investment experience. You can have, as you know, I mean, David pointed out with this managed payout, you can have payouts from the plan that will vary based upon investment performance as a way to make it last longer. There's something called variable defined benefit plans, where the pensions can be paid out of the defined benefit plan and vary based upon the investment performance under the plan. But there is nothing in ERISA that allows for benefits under a defined benefit or defined contribution plan to be adjusted, either lowered or raised, as a result of the mortality experience of the group. Whereas non-ERISA plans, like church plans or state plans, are not saddled with that same lack of availability. So I don't know, and I'm sure David would know more, whether this has actually ever been discussed at any level in Congress, but you know, I am not aware of it other than a proposal that Harkin made back in 2013 with the USA retirement program, which were like IRAs that would have an option to pay out benefits using longevity pooling. That didn't go anywhere for other reasons.
I feel like certainly that every single thing that Mark just said is true. And I also feel that because, at least in the United States, the mechanism for compensation for the ERISA space is assets under management. If it were the case that there were a codified framework for compensation to occur for income, for example, call it income under advisement, if that would incentivize people to use their qualified plans for the provision of retirement income, which is actually part of the name of ERISA. Nonetheless, in the wisdom that our government evidences, it has not chosen to codify income under advisement. If it did, industry groups would be lobbying for product solutions like tontines to be available within ERISA.
Yeah, and one of the key questions is, well, why don't people don't want this? What people don't want is the name annuity. I was at a conference a month or so back where one of the providers had done a very large sample survey. And what people wanted, first off, was a guarantee that they were going to get paid a certain amount, but they equally wanted was flexibility. And when you just discussed what the options were, a certain portion of people liked the concept of an annuity. When you use the annuity label, the support went way down. So it depends on what you call it, among other things. So we can't say that this is something that people don't want. And ERISA, frankly, reflects a certain type or a certain time when it was written and has been amended umpteen million times. So it is a rather a nightmare of a legal document to sit and read. But people could want this sort of thing if it was available and if they understood and if we didn't use the term annuity. Now, I'm going to touch on one other thing just in one sentence. Somebody asked about ESG. ESG doesn't change the amount that you get from an investment pool. It's just one of the things that you consider. And if you think, for instance, that wind energy companies are going to make a huge amount of money in 25 years, and you know you've got a bunch of people retiring in 25 years, that might be one of the things that you think of in there. Other than that, most of that argument is frankly somewhat ridiculous. So,
yeah, thank you for circling back to that question too, David. We of course are out of time. I think we could have another at least 1 hour of good conversation. I appreciate the value that you have added to our goal to educate people and discuss policy solutions that make sense to everyday Americans, so that one day they would understand, right, what basically is available to them and what could potentially be available to them. And I think this webinar was so valuable in that way, in advancing our work as a place to have those conversations. Thank you all again for being part of this. Thank you for an amazing program this afternoon. And thank you to our attendees as well.
Thank you all.